China is growing. At least that's what the official numbers say. Its factories are still running. Its exports are soaring. Its electric cars, batteries, and advanced technology are winning markets all over the world. But stores are running sales all year just to move product. Factories are cutting prices below cost just to keep the lines running. And households across the country are sitting on their cash, too scared to spend it. Officially, China grew 5%, beating its own target, and has accounted for roughly 30% of all global growth over the past few years. Not from a financial collapse, a banking crisis, or a default sparking panic in the streets. This was the world's second largest economy, growing in the official numbers and hollowing out from the inside at the same time. So how does an economy manage to grow and look like it's falling apart at the same time? The strangest part is that China's problem was born from the very same thing that made the country rich.
China's industrial overcapacity is putting growing pressure on economies worldwide, and the world may be nearing its breaking point. Could it, China, trigger a global economic crisis?
More than 2 decades ago, China joined the World Trade Organization. From there, it built one of the most efficient manufacturing and export machines the world has ever seen. Factories, ports, entire supply chains were built to produce cheaper and faster than any competitor. That model delivered decades of double-digit growth and pulled hundreds of millions of people out of poverty, one of the fastest results of any development plan in decades. But every model has a blind spot. China's always rested on two legs, selling to the world and investing heavily at home, mostly in real estate and infrastructure. For decades, those two legs moved together, each one propping up the other. China's current account balance, the gap between what it sells and what it buys from abroad, has reached 3.3% of GDP, one of the largest among major economies anywhere in the world. That's the numerical proof of just how much that external leg dominates. Then one of the two legs started to break. China's real estate sector has been sliding for several years running. New home launches have fallen more than 75% from their peak, and prices for new homes are still dropping month after month, even as that pace has slowed a bit more recently. In many cities, property values have already wiped out 2 full decades of gains. Consumer inflation has hovered near zero, and the GDP deflator, the broadest measure of prices in the economy, is expected to stay negative. In a survey that tracked 67 products and services across China over 2 years, prices fell in 51 of them. That means something simple and dangerous. Prices, broadly speaking, are falling. And when prices fall, people put off buying, betting they'll fall even further. The most recent growth reading slowed sharply to 4.3% year over year. But the number that matters most isn't just that growth fell. It's what's happening underneath it. Chinese consumers are spending less. Youth unemployment has spiked. It's crossed 1 in 6 of working age, without work. At the same time, more than 12.7 million new graduates entered the job market in a single year. The problem is the economy didn't create opportunities at the same speed. China, in other words, started losing its own buyers. The households that were supposed to be spending at home simply stopped. And that problem didn't stay confined to the domestic market. China also started losing demand from abroad. Exports to the United States fell 28% as Trump's tariffs piled up. One of China's biggest external markets was shrinking right as the Chinese consumer was pulling back too. And this is where the numbers start telling a much bigger story. Beijing was losing demand on both sides at once. China's response was simple: sell even more, just somewhere else. China's trade surplus hit an all-time record nearly $1.2 trillion, the largest ever recorded. Exports to Southeast Asia, Latin America, Africa, and the Middle East grew faster than average, offsetting the drop in shipments to the United States. In a recent month, Chinese exports climbed 23.9% year over year. The biggest push came from semiconductors, which nearly doubled in value. Behind that is the global AI boom, swallowing up a large share of China's industrial capacity. Even China's own economic leadership noticed. At a recent meeting, they called for a faster shift toward new growth engines. Beijing knows the current model isn't built to last. Here's the part most people miss. The success of exports took the pressure off the government to fix the real problem. By propping up growth with the export boom, Beijing lost the urgency to stimulate the domestic economy. China never fixed its internal weakness. It just found a way to hide it by selling more abroad. But selling more abroad has a limit: the rest of the world. a surplus this size doesn't go unnoticed. What's happening has already earned a nickname. China Shock 2, a repeat on an even bigger scale, of the period when China's entry into the WTO wiped entire factories off the map in the United States and Europe. This time, the dominance is concentrated in a single sector. China holds roughly 65% of all global intellectual property in electric vehicles and batteries. That's enough dominance to create winners and a growing political backlash. That backlash is already in motion on two different fronts. On one side, direct trade action. The White House is considering banning imports of new Chinese data center components. On the other, currency pressure. The yuan has climbed against both the dollar and the euro in recent months, with trading partners angry and demanding China let its currency appreciate. But looking further back, the story changes. Over the past decade, the yuan has actually weakened 6% against the euro. Over that same stretch, Europe's trade deficit with China more than doubled. That's the root of why so many countries are slapping on tariffs at the same time. For years, China's exchange rate made its products too cheap for any factory anywhere else to compete on equal footing. Not every corner of Chinese industry is riding this boom. Ceramics, a more traditional sector, saw its own exports plunge 28.3% in a recent month. The world, in short, doesn't want to keep absorbing everything the Chinese factory can produce. Beijing isn't sitting on its hands. A domestic campaign, nicknamed anti-involution, is trying to rein in the excess investment in factories that produce more than any market can absorb. The earliest signs are already showing up. Fixed asset investment falling, factory prices ticking up a little, the opposite of the deflationary spiral of recent years. It's small, and it's recent, but it's a practical admission that producing more and more isn't the answer anymore. So, is China's model really reaching its limit? The IMF itself, the institution closest to China's real numbers, has already said it plainly. China can't keep relying on ever larger exports to sustain lasting growth in the years ahead. It's a short sentence, but it's basically a verdict on the entire model that built modern China. And there's an uncomfortable mirror for this situation. Japan in the 1990s. A property bubble bursts, prices enter a persistent decline, consumption stalls, and the country leans harder and harder on exports to make up for weak demand at home. The difference is that China is arriving at this point poorer. China's per capita income today sits around $15,000 in purchasing power parity, against Japan's nearly $25,000 in 1990. Japan got rich before it stagnated. China could stagnate before it gets rich. China's own government knows this. The 15th five-year plan already prioritizes consumption as the new growth engine. The IMF's recommendation is blunt. Pull resources out of industrial subsidies and infrastructure. Redirect them into the social safety net, healthcare, pensions, unemployment insurance. The goal is simple. Get households to stop hoarding cash out of fear and start spending it. A gradual increase in the retirement age, building on a recent pension reform, would also help easing the burden of a shrinking workforce. If fully implemented, these reforms could lift consumption's share of GDP by roughly 4 percentage points over 5 years. On paper, there's a way out. China still accounts for nearly a third of the entire planet's economic growth. That should sound like strength. But there's a contradiction behind that number. A growing share of that growth depends on China selling to the world exactly what Chinese consumers themselves are buying less and less of. And that changes the whole story. If other countries start closing off their markets, imposing tariffs, and protecting their own industries, the model that sustained decades of growth starts losing ground exactly where China needs it most. That's why China's real problem isn't simply growing slower. It's switching engines before the old one stalls out. Beijing knows what the way out looks like. Get Chinese consumers spending more, strengthen the social safety net, and reduce dependence on investment and exports. And the clock may be running shorter than it looks. Because if China can't pull off that transition, it won't necessarily collapse. Something quieter could happen instead. A giant economy that keeps growing, producing, and exporting while having to run faster and faster just to stay in the same place. If you enjoyed this video, follow the channel for more content like this. And tell me in the comments, will China manage to switch engines in time, or will it keep running, stuck in the same place?